Hello, what's up, everybody? This is Sunko, the Korean bro. Today is 2023, May, June, July, June 1st. Okay, let's see. Okay. Hmm. Will Nvidia be $2 trillion stock by 2030? Three numbers that could make you think twice about Walgreens dividend. Roblox buy, sell, or hold. The next imaging. Kathy was selling Nvidia and buying this artificial. Hmm. Okay. Okay, let's see. Will Nvidia be a $2 trillion stock by 2030? Nvidia just made history by becoming the world's first $1 trillion chip maker. The growth of the AI maker lit a raging fire under its stock. In the best case scenario, its market cap could approach $2 trillion by 2030. Nvidia recently made history as the first chipmaker to ever reach a market capitalization of $1 trillion. A large portion of those gains occurred over the past 10 years. As its stock skyrocketed roughly 10,870%, the massive rally would have turned a $1,000 investment into nearly $110,000. Investors might be tempted to take some profits after those multi-bagger gains. But could Nvidia stock double again and hit a $2 trillion market cap by the end of the decade? How did Nvidia just join the 12-0 club? Between fiscal 2013 and fiscal 2023, Nvidia's revenue rose at a compound annual growth rate of 20% from $4.28 billion to $26.97 billion. Its adjusted net income grew at a CAGR of 28% from $728 million to $8.37 billion. Nvidia's growth in the first half of the past decade was primarily driven by the PC gaming and professional visualization markets, but also gradually sold more high-end GPUs to data centers, which installed its chips to accelerate AI tasks. The robust growth of the AI market subsequently drove NVIDIA to launch more dedicated chips for data centers. NVIDIA generated 56% of its revenue from the data center market in fiscal 2023, compared to a mere 7% of its revenue back in fiscal 2015. The ratio of its revenue from the gaming market declined from 44 to 34 during the same period. Nvidia experienced a major growth spurt in fiscal 2021 and fiscal 2022 as the pandemic drove more consumers to purchase new PCs for online classes, remote work, and high-end video games. The soaring use of cloud-based services throughout the crisis also prompted more data center operators to upgrade their servers with NVIDIA GPUs. But in fiscal 2023, NVIDIA's revenue stayed flat, and its adjusted EPS fell 25%. Its growth stalled out as sales of new PCs plummeted in the post-pandemic market, and the macro headwinds forced data center operators to rein in their spending. Rising interest rates also popped the valuations of the market's bubblier growth stocks. Nvidia has a viable path toward reaching the $2 trillion milestone by 2030, but I believe too much of its recent growth was driven by the market hype regarding AI stocks. Therefore, I believe its stock will pull back as its valuations cool off in the near future and then recover again once investors reset their expectations to more sustainable levels. Roblox continues to grow its revenue as well as its customer base. Yet the company's net losses are also still growing rather than shrinking. Interested investors should take a step back and look at the complete picture. Don't jump to conclusions just because the metaverse isn't quite the priority it used to be for Facebook, Parameta. Well, okay, investors aren't quite sure what to make of Roblox right now. At least if the stock's knee-jerk reaction to its quarter first report is any indication, shares initially sold off earlier this month in response to the earnings miss, but having had some time to think about the company's year-over-year revenue growth during the quarter in question, the market then drove it higher by that day's close. The stocks made no progress since then, however. In confusing instances like these, investors looking to make a decision about a particular stock should step back and take an honest look at the bigger picture. Anyone doing this with Roblox right now is likely to end up leaning, surprisingly enough, in a bullish direction. Roblox is doing what other metaverses aren't or can't. Don't misread the message. Roblox still has plenty to figure out. Chief among its current challenges as its lack of net profitability against the backdrop of seemingly warning interest in the metaverse itself. Nevertheless, the company's numbers say Roblox is doing something right. But first things first, on the off chance you aren't familiar with it, Roblox roots are planted the video gaming arena. The company launched back in 2006 as a platform offering gamers a variety of virtual online worlds in which to interact with other gamers. It's unlikely its founders knew at the time the idea would become a model for other such virtual spaces that would in turn eventually be considered the metaverse. But the opportunity eventually fell so big that Facebook even changed its name to Meta Platforms back in 2021, underscoring the company's commitment to the idea. Since then, artificial intelligence rather than the metaverse has become the Meta's top priority. With its intended metaverse platform never quite taking the shape that seemed to be in the cards, Meta's efforts to date isn't the budding metaverse industry's own letdown. Walt Disney's metaverse development efforts were shut down in March, according to Wall Street Journal. Other virtual world creations like Decentraland and the Sandbox are also struggling. But Roblox is doing something right. Despite the disappointing draw the metaverse has been thus far, the numbers say so. Take revenue and bookings as an example. The top line reached a record of 655 billion last quarter, while bookings use of the platform's virtual in-game currency reached a quarter first record of 773.8 billion. Note that both figures are part of bigger picture growth trends. Okay. The number of regular daily users as well as the collective number of hours these people played within the platform's various video gaming rooms also hit record levels last quarter of 66.1 million and 14.5 billion respectively. Okay, given the data, it's arguable that Roblox is becoming or has become the preferred metaverse platform because it already serves a bigger number of people in the most open-ended, flexible environment. It's a dynamic, of course, that's self-fueling. People want to go where most other people already are. Okay, it's not for everyone, but it's for some. So is Roblox a stock pick for everyone's portfolio? No, not even close. Loss-making companies are already difficult enough to own due to their volatility. Companies with increasing net losses despite sales growth, like Roblox, are even more difficult to stick with. Indeed, thanks to rising developers exchange fees, R&D, and administrative costs, Roblox net losses are still growing year over year despite ever improving operating cash flow. Also note that Roblox's average daily revenue per user is shrinking rather than growing. Just bear in mind that this decrease may simply reflect advertisers' reluctance to spend aggressively when the economy is on uncertain footing like it is now. Falling daily per user revenue can also be expected as its scales increases. Well, at the same time, developmental spending will eventually cool a bit as the company scales up. Mm. Detail for burgeoning administrative costs. Well, it also doesn't hurt the bullish case that corporations like Walmart, Nike, and Warner Music are just some of the names using Roblox as their preferred metaverse service provider. These partnerships don't just lend credibility to the idea that businesses can monetize the metaverse. They say that Roblox is able to reliably provide this sort of service to institutions. Connect the dots. This particular metaverse platform is demonstrating persistent growth, while others aren't. It may well be the last one standing after all the others have shut down. If you can stomach the risk and volatility inherent to companies that are currently in the red, but have the potential to turn a profit in the distant future, Roblox may well be a worthy bet for a small portion of your portfolio. So you got Roblox is doing something, uh, doing what others can't. Some of them have shut down, but they're still doing what they have been doing, and its growth have been so far so good. They've increased active users, and they also increased revenue bookings lately, and also yeah, hours engaged. But the bad thing about it is that it's net gain. Net gain has decreased. So so is operating cash flow. But these two can't these two can still be changed. Hmm. Well, at least author thinks it's a temporary thing because uh they reflect advertisers' reluctance to spend aggressively when the economy is in an uncertain footing like it is now. Yes. Uh, Falling daily per user revenue can also be expected as its scales increases. Same time, development spending will eventually cool a bit as the company scales up. Yes. Let's see. Kathy Wood are invested in insanely high conviction in this AI growth stock. What else does she have? Okay, UiPath. UiPath. UiPath is market leader in robotic process automation. UiPath. UiPath. Well, UiPath started as a robotic process automation software vendor, but the company has evolved into an AI-powered business automation platform provider. For context, RPA is a technology that automates simple and repetitive tasks like moving files and completing forms. Mm. But AI enhanced RPA, allowing software to read, write, see, and make complex decisions. The UiPath platform allows users to identify processes suitable for automation and build applications to automate them. It supports simple RPA use cases like copying and pasting document data. It supports complex AI use cases like understanding and acting on document data. Industry experts have recognized UiPath as a leader in several software verticals, including RPA, intelligent document processing, and processing mining. In the years ahead, RPA and AI will undoubtedly become more popular given their ability to boost employee productivity, reduce operating costs, and broader adoption of those technologies should be a powerful tailwind for UiPath. The company currently values its market opportunity at $61 billion, but management believes its product pipeline will push that figure to $93 billion in the future. UiPath reported mixed financial results in the first quarter. Revenue increased 18% to $290 million, a significant acceleration from 32% growth the prior year. But the company generated $867 million in cash from operators, up from a loss of $53 million in the prior year. Investors can attribute the top line deceleration to macroeconomic headwinds. Many businesses have pulled back on IT investments to help control expenses, but spending should normalize as the economic conditions improve. That means UiPath has a good shot at re-accelerating revenue growth in the future. Currently, shares trade at 9 times sales. Discounted a 2-year average of 17 times sales. The price is far from cheap, and UiPath is by no means a surefire investment, but the company does have a strong competitive position in a large market. To that end, risk-tolerant investors should consider buying a small position in this AI growth stock today. Hmm. Okay, let's see. The Cloudflare. CrowdStrike Holdings and Cloudflare. CrowdStrike Holding is a cybersecurity company that uses AI to prevent threats from happening. And Cloudflare is something different. It's as far as I know, it has to do with network, and it's got a lot of data centers here and there, so that if person uses computer, if person uses uh like internet, then it makes internet speed so much fast with that data center really close. I mean, that's what I know, but let's see. Okay, this cloud computing growth stock could help patient investors beat the market. Okay, one phenomenal growth stock down 72% to buy now and hold forever has fallen 72% amid the broader stock market downturn, but the cloud computing company reported solid financial results over the past year. Cloudflare. But let's see, Cloudflare. Hmm. Cloudflare is littered in several cloud verticals, but the company is well positioned to exchange lead into new markets. Management expects revenue to grow nearly fivefold by the third quarter of 2027, leaving plenty of upside for shareholders. Okay, this cloud computing growth stock could help patient investors beat the market. The S&P 500 dropped into a bear market in early 2022, but the benchmark index has rebounded 10% in 2023. And history says the next bull market is coming. The S&P 500 has recovered from every past drawdown, and investors should expect the same outcome this time. Cloudflare has seen its share price drop 72% amid the bear market, but the future still looks bright for this up-and-coming cloud computing company. Here's why. Cloudflare makes the internet faster and safer. Okay, safer. I only mention speed of internet, but it makes also mm, much more safe, right? Cloudflare offers a broad range of cloud services. They improve the performance and security of business critical software and infrastructure. Also provides developer tools to empower businesses to build Performant applications websites. The company has distinguished itself through engineering expertise, immense scale. Cloudflare operates the world's fastest cloud network and the developer platform, and it powers about 20% of the web. Hmm. World's fastest cloud network, developer platform, and it powers about 20% of the web. Cloudflare is also infrastructure agnostic. Hmm. Engineering expertise and immense scale. Hmm. Okay. Agnostic, meaning it can accelerate performance, improve security across any infrastructure. They include private data centers and public clouds, or any combination of the two, meaning Cloudflare is a valuable partner even for businesses that rely on products from cloud titans like Amazon Web Services or Microsoft Azure. So, no matter what service you use, Cloudflare can be used. Probably it's because on top of other layers. Mm. That compelling value proposition has consistently led to a strong financial results. That trend has continued in spite of macroeconomic headwinds. Cloudflare increased its customer count by 13% to 168,000 over the past year, and the average customer spends 17% more. In turn, trailing 12-month revenue climbed 44% to $105 billion, and the company reported $195 million in cash from operations, up from $6 million in the prior year. Investors have good reason to believe Cloudflare can maintain that momentum. Speed and security are important attributes for any software system, uh, and businesses that fail to adequately protect and connect users risk losing customers, employees, or sensitive data. That means demand for Cloudflare services should continue to grow as the world becomes increasingly digital. Hmm. Cloudflare is chasing a massive market opportunity. Cloudflare estimates its addressable market will reach $204 billion by 2026. That figure represents the sum of three broad product categories, and the company already has strong competitive positions in all of them. The first category is application services, which includes CDN software, um, and web application and API protection platforms. Cloudflare is leader in both verticals, but should be able to extend its leadership to other verticals, given that it operates the most performant cloud network in the world. The second category is network services and zero trust security services, an area where Cloudflare is well positioned to take share with its secure access service edge product Cloudflare One. The combination of freemium pricing and unmatched performance has drawn a tremendous number of users to Cloudflare. As discussed, about 20% of the web runs on its network, and handling all that traffic gives the company a material advantage. Cloudflare has deep insight into performance issues and security threats across the internet. The third product category is developer services, another area where the company is poised for growth. In late 2021, Forrest Research recognized Cloudflare as a leader in apps development platforms, but has since reinforced its leadership with new storage solutions. R2 Storage supports unstructured data like documents, images, and videos. R3 is a faster and cheaper alternative to Amazon S3 standard. Similar, D1 database supports structured data. Every application website requires database. And D1 means businesses can build applications in Cloudflare without provisioning an actual database. The case for market beating returns. Looking ahead, management expect revenue to increase nearly fivefold to $5 billion by the third quarter of 2027. Okay, let's briefly summarize what I just read. They got 3 points, and it's what they're leading. And first is CDN software, application services. And the second one is Sentinel One, Cloudflare One, which has something to do with security services. Third one is a developer or something, some services. Ad development platforms. Okay, for that three perspective, Cloudflare is a leading company. Okay, and the case for market beating returns. Looking ahead, management expects revenue to increase nearly fivefold to $5 billion by the third quarter of 2027, which implies annualized growth of 41%. During that time period, better yet, the forecast refers to organic revenue growth, meaning it does not account for any new products the company may develop to the interim. With that in mind, Cloudflare stock trades at 19 times sales, a bargain compared to the 3-year average of 41.8 times sales. The valuation multiple is certainly not cheap. So the stock could be volatile in the near term, but the rapid revenue growth forecasted by management will put downward pressure on the price to sales ratio. For instance, if Cloudflare's market cap doubled from $20 billion to $40 billion over the next 4.5 years, shareholders could see annualized return of nearly 17%, a figure that should easily beat the market, while the valuation multiple fall to a much cheaper 8 times sales. Hmm. Okay, cool. Last time I read an article about CrowdStrike Holding, and now it's Cloudflare. Uh, Airbnb, Verizon Communications, Etsy. Here's Etsy again. Wow. Three no-brainer stocks to buy with what $400 right now. However, the major stock index is all trend higher over longer periods, which makes corrections and bear markets ideal buying positions. These phenomenal businesses have the competitive edges and sustainable catalysts necessary to deliver for their shareholders. And let's see, Airbnb. What does he say about Etsy? Okay, the third no-brainer stock that makes for a surefire buy with $400 right now is the e-commerce platform Etsy. For Etsy, the strongest headwind is the expectation of U.S. economic weakness. There hasn't been an instance over the past 6 to 8 years in which the Federal Reserve has increased the federal funds rate by more than 3.1% without a recession following the rate hiking cycle. We're well past this point in the current cycle, which could bought poorly for retail-focused companies like Etsy. On the flip side, recessions have lasted just 2 to 18 months since World War II. Though economic downturns are inevitable, they don't last long. Comparatively, periods of economic expansion typically last for years, Hmm. which is good news for retail-driven businesses. What separates Etsy from the pack is the personalization its platform provides. While Etsy doesn't hold a candle in terms of sales and active buyers and sellers to an e-commerce platform like Amazon, a giant like Amazon can't match the level of product personalization that small merchants can offer buyers on the Etsy platform. This unique niche that Etsy occupies should shield it from larger competitors. Despite some near-term weakness in retail sales, buyers' trend for the company have been promising. In particular, habitual buyers have more than tripled compared to where they were prior to the start of the pandemic. Habitual buyers have more than tripled. Habitual buyers are those who have made 6 or more purchases over the trailing 12-month period, with aggressive buys totaling $200 or more, with reactivated buyers and habitual buyers well above pre-COVID figures. Active appears poised for ongoing growth. Active innovations have also put the economy in a position to succeed. On the one hand, it's investing heavily in various research and discovery initiatives designed to connect buyers with sellers. On the other hand, it had no trouble increasing service fees for sellers. Being able to boost its take rate while also growing the aggregate number of buyers and sellers using its marketplace demonstrates the power of the ads platform. Yeah, let's read a bit about Airbnb. The first no-brainer stock that's vagging. Let's read a bit about Palo Alto Networks. Okay, Palo Alto. Palo Alto Networks. Okay. Hmm. The third stock split that owners can't stop buying is cybersecurity company Palo Alto Networks. Palo Alto completed a 3-for-1 stock split last September. Based on Form 13F filings, these successful billionaire money managers took the plunge, with Palo Alto, including Stephen Cohen of Point 72 Asset Management, is listed above these billionaire investors, purchased in the neighborhood of 571,000 571,400 shares. 355,100 shares. Hmm. The great thing about cybersecurity stocks is they've evolved into basic necessity solution providers. Necessity solution. Businesses were sadly moving the data online and into the cloud prior to the COVID-19 pandemic, but over the past years, the shift has accelerated. No matter what's happening with the stock market or US economy, businesses of all sizes, whether online or cloud presence, need to protect their sensitive information. That's good news for Palo Alto and its peers. What's really powered Palo Alto's growth over the past couple of years is it defined shift toward cloud-based software as a service solutions. Although it's not banned on physical firewall products, the percentage of net sales derived from a SaaS subscription has grown from a 61% in fiscal 2018 to 78.3% through the first 9 months to fiscal 2023. Subscription-driven operating model should enhance its gross revenue retention uh, and provide a lift to the company's long-term operating margin. Something else that's likely raising the eyebrows of billionaire fund managers is Palo Alto's ability to land big customers and course add-on sales. The company now has 25 accounts generating at least $10 million in total bookings, which is more than double from where things stood at this time last year. Furthermore, the percentage of Prisma Cloud subscribers that purchased full or more modules grew 90% year over year in the fiscal third quarter. Landing the big fish and netting out on shelves is an easy way to continually trounce Wall Street's revenue and profit growth forecasts. Hmm. Palantir, shares of Palantir Technology have been hot this year, rising more than 125% since the start of January, and it's now trading at a 52-week high. But despite the stock's resurgence this year, it still may not be too late to invest in the data analytics company. As still there's plenty of growth potential ahead for the business. Profits should be the norm moving forward. Last year, Palantir incurred $374 million net loss, and that was an improvement from a 2021, which net loss totaled $520 million. Today, however, the business is on a much better trajectory, posting a profit in consecutive quarters. And the company anticipates that trend continue. In a recent letter to shareholders, CEO Alex Kopp said that management expects the business to be profitable throughout the rest of the year. If Palantir is finally consistently profitable, that could make the business a much more tenable investment to own. Plus, it could result in getting into the S&P 500, which will be sure to attract more visitors, even ones who are risk averse. Uh, Generate strong gross margins of close to 80%. Artificial intelligence has been a hot topic this year due to the fact that ChatGPT and next-gen technologies can transform, improve any business. Palantir is no exception to that. The company's operations centers on data analysis and helping companies and governments make decisions and upon analyzing many different data points. Palantir is in the process of launching an artificial intelligence platform. It says will enable customers to take advantage of its machine learning technologies. It mentioned in the company's anonymous code and made that demand for AIP is incredibly strong. It's nothing like he's ever seen in working for the company for the past 20 years. The company's technology can be used in counterterrorism operations and will. In April, it showed a demo of how its AIP can help assist with deploying drones and estimating on enemies' capabilities and strategy. AIP can take Palantir's business to the next level, allowing AI to do more data analysis, saving time for businesses and governments in the process. Blah blah blah. So Palantir has got some plan to make a AI platform so people can use its service to do as they wish, right? Hmm. Anyway, this is it for today, and I'm gonna see you tomorrow. Okay, bye bye.